So tonight we are going to be looking at the cash management models. This is an aspect of the management of working capital. So the cash elements of the working capital will be the focus of tonight's class. In the last class, we looked at the issue of inventory. So tonight, we're going to delve into the cash aspects. Cash. So from our previous knowledge, our background knowledge, when we talk about cash, what do we refer to from our background knowledge? Talk about cash. What do we refer to based on our background knowledge? When we talk about cash. Yes, can I get a response?
Hello, sir. Good evening, sir.
Ima?
Yes, sir. Cash can either be cash at hand or cash in bank.
Okay, cash at hand, cash in bank. Okay. When you're trying to look at, when you're trying to compare those elements of current assets, which is the most liquid
Cash.
Cash,
and why
the
is
one
it the most liquid?
because
Why is
it
it the
can be
most
easily accessed. It can be easily accessed.
liquid?
It is ready to use for anything, for any transaction.
Okay, okay, yes. So,
Yes. Cash can be used to offset liabilities, current
okay,
liabilities.
so the language of business is what? Is money. That is the language of business. So you can easily access cash. Once you have cash, you can use it to offset any liability. Once you have cash, you can use it to settle any obligation. So, and that is why it is the most liquid. It is the most liquid among every other forms of current asset elements. Now, when we talk about cash, cash is what we use for day-to-day transaction. It is the money elements we use for business activities. Once you have money, you can decide to venture into anything. You can decide to collect goods on credit. You can decide to invest. You can decide to buy much stocks and pile up. Now, the essence of this topic is to enable financial managers know how much cash to keep at every point in time and how much cash we are to use at every point in time. It means we must strike a balance between the cash we keep and the cash we are spending. That we will not run short of cash at any point. It means there must always be break-even balance between what we are keeping and what we are spending in form of cash. It means that we must not keep too much cash, because when we keep too much cash, we'll be losing profit. Yes, and when we don't have enough cash, we'll run short of what? Will become will not be liquid. Yes, we might become insolvent. So there must be a point of balance between the cash we have to make profits and the cash we have to offset short-term obligation. So I want to ask, though I've asked this question before, if Profad answers to it, but I still want to ask again that what are the motives for holding money? What are the motives for holding money?
A transactional precautionary
A precautionary measure
Precaution. Precautionary
and
measure.
speculative
speculative
measure.
motive.
Very simple to make expenses.
I like your direct answer. Like, it's very simple.
To make expenses.
But I still have a question for you. You said very simple to make expenses. Now, the money you have to make expenses, there is a definition for it. Why are you holding money for expenses?
I can meet up with my business now so that I can meet up with the things required in my business or in my company.
Okay. And those things you are meeting up with, they are called what? Transactions. Isn't it, sir?
Yeah,
So
it
it
is.
means the essence of holding money to meet up with those activities, you are holding money for what? Transactionary motive.
Exactly. Yeah.
You are holding money for transactionary motive. You can hold money for other purpose, isn't it? When
Yeah.
you always have a reserve somewhere. Even when
Yes.
somebody come knocking at your door and say, this is it, oh, that reserve, it will take somebody very close to you for you to touch that reserve, isn't it, sir?
Very correct.
So that money you are keeping in form of reserve can be termed as what? Why are you holding that?
Mm.
For precautionary purpose, sir.
Okay.
For precautionary purpose.
Emergency.
Emergency. Unforeseen circumstance. Now, there's another one. I'm trying to break it down so that you will not say it's very simple for because when you see this can come in exams very well. It can come in diverse ways. So there are three motives in which they've mentioned. One is transactionary. One is what is precautionary.
Precautionary.
And the third is what? For speculative motive. Speculative motive. And when you hold money for speculative motive, you are holding money as an investor. Holding money, putting your money in ventures that you see that in some time to come, there will be return that will be favorable when you put your money in it. Now, when you invest in grains, store them, you are foreseeing that the price of those grains will increase in some months to come. When they increase, you pull them out. That is, you're holding money for speculative motive because you are not very sure. You are just speculating. Yes. So when you hold money for that purpose, you are holding money for the essence of investing with the hope of higher return in some time to come. So those are the three motives for holding money. You can see three motives for holding money. And from the slide, I have it that they include the transactions motive, the precautionary motive, the investment or speculative motive, and failure to carry sufficient cash levels can lead to loss of settlements discounts. Loss of settlement discounts. What do we mean by loss of settlement discounts? When there is an opportunity for you to quickly embrace a purchase in bulk, and because you don't have sufficient cash to meet up with that particular opportunity, you can lose that settlement and you end up paying more. And when you don't have sufficient cash, you can lose your goodwill. Some of these we've analyzed, similar to what we analyzed when we're talking about inventory. You can lose your goodwill because you don't have much money to meet up with your obligations that you've already entered into for some period ago. And when it is time for settlements, there is no money to meet up with that. And it can also result into poor industrial relations, because those that are working for you, they might have association, and once they are not meeting up with their obligations in terms of wage and salaries, there can be unrest in the organization, and there will be longer heads between the associations and the management of the organization, and it can result into liquidation when you don't have much fund. And that is why in one of the classes, I think is in the other platform, where I said that it is very important to look at the cash viability of a business rather than looking at the profits they are showing you in their financial statement. They can show you a profit that is not real, yes, due to various cosmetic accounting procedures that some organizations apply. So if you want to know if a business is healthy, look at their cash flow analysis, and that's, you can easily ascertain if a business is healthy rather than the window dress profits in their book of accounts. So this will lead us to talk about cash management models. There are models that we use to determine the amount of cash we should hold at time, to know if we are going beyond a particular limit or if we are going below a particular limit. So there are models that have been put together by some financial management analysts as part of a study for us to look into, which we are going to look at them. Now, in financial management, I would say that cash management models are techniques used to determine the optimal level of cash a firm should hold. You know, in the last class, when we're talking about inventory, we have the economic order quantity to determine the level of stock at time that an inventory can hold or can purchase, and looking at the total cost likewise of holding or purchasing stock in batches. So in financial management, cash models are tools used to determine the optimal level of a cash a firm should hold. Now, why are we talking about this? The objective is to ensure that the firm has sufficient liquidity to meet obligations while minimizing the cost of holding the idle cash. Because when you hold cash in your hands, you are losing opportunity. The opportunity you are losing is the profits that the cash would have brought into your business if you have engaged the cash. But when you keep the cash idle, there is loss of profits. But when you put the cash into use, there will be an inflow in the long run, which will aid the business growth. So these cash management models, what they do is that they can help an organization to decide when to convert marketable securities into cash. That is, if you have security in a place, you have an investment in a place, and the value of the investment have increased, and you are now seeing it as a very good opportunity for you to sell that investment to have cash. And you speculate, you look when the value of that investment is low, you buy again and keep hoping for a time when the value of the investments will rise again. So this model help a business, an organization, to convert marketable securities into cash. And one thing this model does again is that it helps a firm decide how much cash should be held at a particular point in time, and when excess cash should be invested. When you have excess cash, this model will also lead you that you're having too much cash. It's time for you to invest because it is going above the limits you've set. So these cash management models are important parts of working capital management because they help a business organization to ensure that adequate liquidity is available for daily operation. It helps the business organization to minimize the opportunity cost of idle cash. It helps an organization to reduce transaction costs associated with converting securities to cash, and it helps an organization to maintain optimal cash balance. So that is why these models are important. If you look at this diagram on my slide, you can see that we have a battle between liquidity and profitability. What is the battle? The battle is how can we strike a balance between the amount of cash we should hold and the amount of cash we should put into profitable venture that will bring about profitability. So every business must have a policy, a cash policy, to enable them maintain certain level of cash within a particular limit, for them not to keep excess cash, and for them not to keep less cash in their business. So from this diagram, you can see cash balancing act. How do we balance the cash? Now we have the case of when you have liquidity, it will enable you to pay your bills as they fall due and take advantage of what opportunities at once. And when you minimize the cost of holding cash, that is putting your cash into other profitable ventures, what will happen? You get returns. So you get returns. So the issue facing most organizations is what should be the appropriate level of cash I should keep in form of liquidity. How much of my cash should I invest to bring in profits? This is always a decision that most organizations are always faced with at some point in time, because at the point where you are putting too much cash in investing, an opportunity can come for you that you need quick cash to finance a business, but you've already tied down your money in another investment. So there must always be a balance to achieve this. So still on the issue of cash management models, we are expected to look at cash budgets and cash flow forecasts. Budgets and cash flow forecasts. This is what we look at in performance management, while we're treating the issue of budgets, where we have the inflow and the outflow. But I'll still take my time to read through what I have on the screen to explain for those who were not in that class. So when we talk about cash budget, we're talking about receipts and payments in form of what? In form of cash. In form of cash. And in a question, they can give you sales, they can give you purchase, but it's not the whole of that sales value that is cash at the immediate. It's not the whole of the purchase figure given to you in the question that is cash value at the immediate. So the question will test your understanding of your ability to separate cash elements from credit elements. So A cash forecast is an estimate of cash receipts and payment for future period under existing conditions. So a cash budget is a commitment to a plan for cash receipts and payments for a future period after taking any action necessary to bring the forecast into line with overall business plan. So when you are asked to prepare cash budget, don't go and pick the whole sales value in a question and put it as an inflow. Don't go and use the whole purchase value in a question and use it as an outflow. Definitely the question will give you certain notes that cash sales is 40% of the overall sales figure, depending on how the question frame it, depending on how the question is coming up with it. So take note of these in relation to cash budget. So still on the issue of cash budget, you will have two parts. Yes, this is just like a pro forma, a format of how cash budget looks like, which we dealt with in performance management for those doing performance management. And if you've passed performance management, it's expected that you have this understanding so that that part will not be questioning. So because knowledge is cumulative. So when you are preparing your cash budget, you have the aspect of receipts and you have the aspect of payment. It can be cash inflow or cash outflow. So when you have your receipts, most times the receipt can just be sales and receivables. That is why you can see on the slide just few lines. And once you add your total receipts, either in form of cash sales, receivables, you have your subtotal, as you can see in this format. And you can have your outflow or payment. You can have many issues under these payments. You can have issues of purchases. You can have issues of rent. You can have issues of salaries, depending on how the question is coming up with those issues. And you identify the cash elements and present as appropriate. And the budgets can span for like 4 years, 5 years, 6 years, 2 years, depending on what the question is presenting to you. So as you determine your total payment, you have a subtotal. Now the difference between your receipt and payment will give you what? We give you your net cash flow. We give you your net cash flow. And for you to get your closing balance for year one, there should be an opening balance before year one. And if there is no opening balance, fine. What you do is just to have dash as your opening balance. That is 0. 0 plus your net cash flow will give you your closing balance for year one. Your closing balance for year one will be what? The opening balance in year two. That is why you can see the arrow. Your closing balance in year one will be your opening balance in year two. Your closing balance in year two will be your opening in year three. And your closing balance in year three will be what? Your opening balance in year four. So we've treated a question related to this in performance management, the Ozigondu, and the other question, even the one of last year November question in performance management, similar to this. So we've solved a question that involves receipts and payments. And in case you need a refresh, I'll send the video of that class to the platform for us to watch and see the analysis of the issue of cash budgets in relation to inflow and outflow. So I can still send a question for us to attempt, yes, in relation to these aspects, because I will send a question for you to separate your receipts and inflow and come up with a budget. These are just in form of explanations to this format here. That step 2, fill in the simple figures. Some payments need only a small amount of work to identify the correct figure and timing. Yes, they can tell you credit sales, you have 1 month. Your purchase, you have 2 months credit period. So you must take note of those timing, and you need to enter them as appropriate in the table. So you can have those issues in that slide. And step 3, based on this slide, I said work out more complex figures. The information on sales and purchases can be more time consuming to deal with. Yes, I believe some people can confess. Like for the last performance management question in November, I know somebody that's used like a whole day to analyze. Yes, using a whole day to analyze does not mean um, is trouble. When you are in the comfort of your room, yes, you need to sit down very well to analyze those questions so that you see them again, you will use less time to solve them. Yes, and when you see such kind of question, the knowledge in hours to break down the question will help you to move very fast when you see such again. So sometimes when you use hours to solve questions, don't complain. It's an investment in time that will pay off some time to come. So that is how it works. So the information on sales and purchases can be more time consuming to deal with. So the timings for both sales and purchase must be found from credit periods. Variable overhead may require information about production level purchase figures, may require calculations based on production schedules and inventory balances. So all these can form part of the notes, the additional notes in the question. Now, talking about the cash management models. These cash management models are aimed at minimizing the total cost associated with the movement between your current account and your short-term investment. So the cash management model, we have basically we have 2 models. Yes, we have 2 models in talking about the cash management model. We have the Baumel cash management model. The Baumel cash management model. Now, this Baumel cash management model was developed by William J. Baumel. Yes, and the concept of this model is that the model applies the economic order quantity principle to cash management. The economic order principle you are very much conversant with is what this model have adopted. It's telling you that the operation of cash is not far from the operation of stock. So the cash model can be used to assess the cash decision an organization should take when it has surplus cash or cash deficit. So this implies that a cash model can assist with deciding how much cash to hold. Yes, can help you to decide how much cash to hold, when cash is needed. That is the function of a cash model. It can tell you when cash is in surplus or deficit, how much cash to invest in the short term, how many investments to settle to obtain cash, is based economic order quantity model that we use for inventory valuation, for inventory valuation. So the Baumel model shows the optimal that should be obtained each time short-term investments are sold. The model works on this assumption that so it assumes that cash usage is constant daily throughout the year and predictable. And also, it also works on the assumption that cash inflows are known and regular. And also on the assumption that day-to-day cash needs are funded from current accounts. And buffer cash is held in short-term investments. What is buffer cash? What is buffer cash from your knowledge of buffer stock?
Buffer will now be idle cash.
Okay. So buffer cash, idle cash. That is this buffer
And the
cash.
reserve.
Okay, all right, fine. So the buffer cash is the cash level that is telling you that it is time to get more cash. It is the safety cash balance level. You understand? That is at the point where your cash is getting to, is at that buffer level. It shows that there is a signal, restock, restock. So the buffer cash is the minimum amount of cash a firm keeps on hand to meet unexpected cash needs or emergency. So it's a safety cash balance. So this buffer cash is the reserve. Is the reserve cash balance that is maintained by a company to protect against uncertainty in form of cash inflows and outflows. So because somebody can just knock on your door untimely, it is that buffer cash that will save you at that point. You understand? So some businesses cash flows are often unpredictable. So when your cash flows are not predictable, what you need to do as an organization is to hold buffer cash to ensure that you can still meet up with certain obligations, such as your payments to your suppliers, salaries and wages, your utility bills, and any emergency expenses that can come in the way of the organization. So that is some of the assumptions that this model works on. And looking at this model, we should have an example. The model, we all know the economic order quantity formula, right? So you can see that in display again under the cash model, specifically Baumel model. Now the formula calculates the amount of funds to inject into the current account or to transfer into the short-term investment at one time. Now this is the formula where we have what? Everything into the roots of what? To the square root of what? 2 multiplied by what? By your transaction cost multiplied by what? Your demand for cash over the period, divide by what? Your cost of holding cash. Please ignore this underline here. The one that we're working with is this slant one here. So the 2 COD is divided by what? CH. And what is CO? Is the transaction cost or brokerage commission cost. It can be fixed cost of obtaining new fund. And what is your D? Your D is what? Demand for cash over the period. Your demand for cash can be for a year, can be for a month. So depending on what the question is telling you at time, that is what you work with. And your CH is what? Your cost of holding cash or the interest cost of holding cash. That is the opportunity cost. So that is the interpretation of those items there. So the idea about the Baumel model is that your transaction costs can be in form of you selling securities too often, and the opportunity cost can be in form of you holding too much idle cash. So looking at this, let's see if we have an example to illustrate this. Now we have this example here that Noble has a fixed cost of 500 naira to obtain a new fund. To obtain a new fund, there is annual requirement of 1,040,000 with interest forgone of 7% per annum. What is the optimum level of cash from Noble? From Noble, the optimum level of cash for Noble. Now, based on the EOQ formula. And based on the definition of the various variables in the previous slide before this, what do you think we can do? Let me go back to the slide. And some people might not put it down. Write it down in your book. So we'll now come to the question and bring out the variables one after the other. Hope we've all done that. So now, looking at the question, Noble has a fixed cost of 500 naira to obtain a new fund. To obtain a new fund. What is the definition of 500 naira? What is the definition of 500 naira? From this interpretation. Yes, transaction cost. Transaction cost. Transaction cost. Let's go back to the question. Noble has a fixed cost of 500 naira to obtain a new fund. To obtain a new fund. What is CO? Transaction cost of fixed costs. Isn't it? Of fixed cost of obtaining a new fund. It's clearly defined here. Clearly defined. So now it means you identify your CO, right? Fine. There is annual requirement of 1,040,000 with interest forgone of 7% per annum. There is annual requirement. This annual requirement is what?
Demand.
Demand.
Demand for cash.
Very good. Demand. Demand. Let's see it. Demand for cash over the period. See it. Demand for cash over the period. So that I don't want anybody to be in this class and you say something is confusing. That is why I'm doing it like this. It's very defined. Let's define each variables one after the other. So when I give you class exercise, you give me my answer as expected. So now, going back to the question, there is annual requirement of 1,040,000 with interest forgone of 7% per annum. Interest forgone of 7% per annum. 7% will be what?
Holding cost.
7% will be holding cost. That is cost of holding cash, interest cost of holding cash, or opportunity cost. It means the interest of you pay for getting this value will be what? 7%, isn't it? 7%. So when you substitute all this into this formula here, what will be your answer? What will be your optimum level of cash? What will be your optimum level of cash? We are waiting for me to solve it. The exam is here. I want you to be solving. It's better you try and not get it now than going to try in the hall and put your hand in your head. I don't want that situation. So what will be the value? Optimum level of cash.
I'm not sure if I'm correct.
Yes, try.
121,889.88.
Okay. So somebody else will testify to that.
Yes. 121,890 is correct.
121,890.
Fine. You are not getting 121,890. Speak out now. Anyway, let's show it. You know, some people are like me, we don't speak out. You understand? But it's good you speak out. Yes. So let's just show the workings. So you learn to speak out. So we have our CO is what? Multiplied by what? From our analysis, CO is what?
500.
Good.
And the D is what? So your optimum cash level will be what? Your optimum cash level will be optimum cash level will be so the optimum cash level would be 121,890. 121,890. 121,890. Let's take this class exercise and see. Let's take this class exercise. Victoria Limited. Victoria Limited. Madam Macaulay, are you in this class? Victoria Limited makes payments to its suppliers. What's 18 million? What's 18 million a year? The transaction charge of 150 naira will be paid each time. Will be paid each time investments are converted to cash. The opportunity costs of holding cash rather than investing is 6%. 6% per annum. 6% per annum. the payment is assumed. The payment is assumed to be constant daily. To be constant daily. Required. Required. A, we have it as calculates what quantity. Calculate what quantity of investments. Calculate what quantity of investments should be sold whenever cash is needed. Whenever cash is needed. Hope you are already solving. By Victoria Limited. And the B is calculates the number of cash. The number of cash transfers. Number of cash transfers during the year. This is not far-fetched from what you've been doing under the inventory. Those of you, I can see quite a number of persons solve that assignment. You know, as you are posting on the group, some people have been challenged. Wow. Is it only me that will be left out? So as they see people posting it, they'll quickly go and check too. I'll not be the only one left out. They'll solve. And that is the essence of me asking us to send those assignments. But I don't want you to be in my class and just be there. Yes, I'm seeing like 80 persons in that platform. That's why I didn't use the last one I used last night. Created another one. But I've not seen 80 assignments. Yes, it shows some people are just there. So now looking at this question, what are we going to do? Is a class exercise, brainstorm. What is the answer for A?
A is 300,000.
How did you come about that, sir?
I use the formula 18 million, 2 times 18 million times 150, which is the transaction cost. Then I divide it by the opportunity cost, which is 0.06. Then the square it.
Yes, that is very good.
Then the B is 9,000.
B is 9,000. How did you get that, sir?
The requirement, that's 18 million divided by that, the figure of A, which is 300,000. Then I have 60, which is the number of order, then multiply by the cost transaction, which is 150.
No, look at the B, sir. Calculate the number of cash transfer. The number now, not the money value.
Okay, 60.
Very good, very good. Yes, that is very good. So you are not getting 300, you are not getting 60. Speak out. You know, it's class exercise now. It's for me to know if you followed the first one. So if you didn't follow the first one, it means maybe.
Okay.
Yes. So who is not getting 300? Don't be shy.
So I'm not getting 300 though.
Okay, very good. You get it.
Madam Mary, mute your mic now.
From that formula, you have that formula in your book. You have that formula in your book, right? It's Ben. I want to hear from you.
Yes, sir. I have the formula, sir.
Very good. You know 2 is constant.
Yes, sir.
So if 2 is constant, what is your CO?
My CO is 150.
Your CO is 150. Fine. Now, what is your D?
My D is 18 million, sir.
Very good. When you divide those variables by your CH is what?
My CH is 0.06.
Okay, fine. So when you put everything in the square root formula and you simplify, what will you have?
I have 5,400,000.
Oh, something is. Then you put it. Did you square roots? Did you do the square roots?
Yeah.
Something is happening. Your variables are correct, but the what now? The computation is not giving us the right answer.
Okay.
I use the square root.
Try it again, sir.
So when you solve, pick your final answer and press that square root, put the result inside. You understand?
Okay.
You know how to, yes. So when you solve, you should have 300,000.
Yes, I got it now, sir.
Good. In case you are still there and you didn't get it and you are keeping quiet, you know, some bishops will tell you that a closed mouth is a closed destiny. I'm just borrowing the words. You know, I'm not a Ma?
I've not gotten it. I'm not getting that square root.
Okay. Why are you getting when you multiply 2 multiplied by 150 by 18 million? What do you have, Ma?
I'm trying. Let me do it again.
Yes, do it again.
Yeah, so I'm getting 5.4 million.
So now divide by 0.06.
Divided by 0.06. 9 raised to the power of 10.
Hey, your calculator is in standard form.
That's why. So let me adjust that.
Yes,
More.
you can press second function and press num.
Second function. What is second function?
Shift.
Okay, shift. Okay. Shift, then what?
Num. You see, I don't know your calculator, how it works. Yeah, but
Mode. No. What do you call it?
num.
Sorry,
N-O.
it's noisy. It's a bit
Or
noisy.
some persons press mode. Then you
Mode.
see 3 options will come up.
Mode. And it's showing a complete complex. 1, 2.
So I think you see num. If num is 2, you press 2, something like that.
I did 2 and it's showing me CMP complex. It's now
So
on
what's
complex.
please, somebody should do the computation and just screenshots using your calculator. Just screenshots as your computation on calculator and send to the group so that we will not so that everybody can see how it works. Yes, you can just do it and snap your calculator and send to the platform so that everybody will get it. So for the number of transfers, it will be what? Your 18 million divided by what? 300,000 to give you the number of transfers. That's calculate what quantity of investment should be sold, calculate the number of cash transfer. That's Victoria Limited makes payments with suppliers worth 18 million a year. The transaction charge of 150 will be paid each time investments are converted to cash. And the opportunity cost of holding the cash rather than so per order, you should order what? 300,000 per order. So, and if you are getting 18 million in a year, how many times will you get 300,000 in a year? So it means 18 million divided by what? 300,000. You get that? It means the number of times you will be asking for 300,000 will be what? Be 60 times. Be 60 times. That is the interpretation of the B. That is the interpretation of B. Yes, Madam Rose.
Okay, sir. Good evening, sir. Sorry, I don't mean to take us back. When I did my own square root, I was getting 3.
3.
Yes. When I did 2 times 150 times 18 million divided by 0.06, then square root. Or is there something I'm doing wrong?
Okay. Please, everybody, those that have the answers right. So let's show it step by step. 2 multiplied by 150 by 18. What will you have, please?
2 times 150 times 18.
5,400 million.
You have
5,400 million.
5,400 million.
That is serious. 5 billion 400
million.
Okay. Can you call the figures for me? 5
500 million.
Okay, 500.
Comma 400.
Yes.
5,400 million.
0, 0, 0, 0,
10
0.
million. Okay, fine.
Yes.
So this is what you have.
Yes, sir.
Divide by 0.06. So once you do this,
Online.
when you divide 5 billion 100 million by 0.06, what will you have?
9.
90 billion. 90 billion.
Okay. It suspended all the zeros. My calculator suspended the zeros. I'm just saying 10 zeros.
Is that 90 billion?
Yes, sir.
So when you square this, square root of this,
4. It's 7, 8. Okay.
300,000.
This should give us 300, right?
Yes, sir.
Yes, sir.
So hope this is clear now.
Yes, sir. Sorry, my calculator suspended is 0. You just told me 9, then just by the side and now for 10.
That is good.
Mm.
This is an assignment for you. This is an assignment. Yes, Temitope? Madam Rose, you can put down your hand now.
Hello.
Yes.
Yeah, I said, can we please go back to that class exercise? There's a phrase there that said, or a statement rather, the payment is assumed to be constant daily. What does that mean? Because I was thinking we're supposed to multiply something by 365. I don't know. What's that? What's the meaning of that statement?
The meaning of the statement is that the monthly payment, the payment to suppliers is same, does not vary. So it means that if you are getting 300,000 every order, that is the same 300,000 you are to get. If you are getting daily, you are getting if you are getting 20,000 daily, it is same 20,000 daily. So if you divide 18 million by the number of days in a year, what will you have? By the number of days, it shows whatever you have is constant. It does not change. Does not change. So the issue of the payment is assumed to be constant daily. Yes, we are working based on the cumulative value. So we are not breaking it down to see how much we are getting per day. That the opportunity cost of holding cash rather than investing per annum is this. So we're working based on the whole year value. So if you want to now go further to get it daily, what will you do? These 300,000 that you have, you can still divide by what?
365 days.
Fine. So you can go further to get it in days, but we are not working based on that. Calculate the number of cash transferred during the year. Fine. So because of this B, we need to work based on the year value. So it is the yearly value that will be able to determine how many orders we have in 18 million. So this statement is there. For example, the question can still go further to tell you what is the daily transfer or the daily order. Then you can come up with the issue of 365 days and work for them. So for this, it's not relevant.
Okay, thank you.
So this is an assignment question for us to make an attempt. An assignment question for us to make an attempt. So that is the Baumel model. That is Baumel model. We have another one, another interesting one.
Hello, sir.
Yes, sir.
So I think this issue of EOQ, the question sometimes makes me not to understand whether to use EOQ or not. The first example you gave, Noble, the requirement, what is the optimal level of cash for Noble? What is the optimal level of cash for Noble? we stop for the EOQ. Now, for Victoria, the question is, calculate what quantity of investment should be sold whenever cash is needed by Victoria Limited. And this assignment you gave us now, go to the assignment. The A part of it is having another
grammar. So what is the grammar, sir?
What is the optimal amount of cash to be invested in each transaction?
Yes, sir. So when we define EOQ, what was our definition, sir?
Can I remember now?
Okay.
Economic order quantity now.
Yes.
The cash is constant or steady.
Yeah, is the optimal quantity. The optimal quantity of cash or inventory a firm should order each time it requires cash or it purchase stock, because it is a concept that we can use in terms of inventory and cash. That is why I'm bringing the two now. Do you get, sir?
Okay. It's okay. Yeah. And I remember. It's true. It's okay. Thank you, sir.
So this is a very good assignment that you can also play with. Yes. And see how far you understand what we discuss. But we are not yet at the climax. Let's see go. This is the second issue we'll discuss on the issue of cash management model. That is the Miller-Orr model. I remember last diet, a student asked me the formula we are using in this Miller-Orr. How did we come up with it? Well, it's quite unfortunate I was not part of those that maybe the economists that propounded some of these things. So sometimes I might not be able to provide answers to some of those questions. But they are there in the literatures for us to study and pass our exams. The Miller-Orr model was developed by Mentor Miller and Daniel Orr. And the concepts, unlike the Bauman model, this model assumes cash flows are uncertain and assumes that cash flows are random. Now, when you're looking at Miller-Orr model, the key elements we are to look out for, we have the issue of lower limits, we have the issue of upper limits, we have the issue of return points, that is the target point. Now, these lower limits, it shows that once your cash level is getting to that lower limit, what will you do? If you have investment somewhere, sell it and bring in cash. What is your upper limit telling you? Once your cash limit is going above the limit, the upper limit, what will you do? Invest your cash. Put your cash, tie them into investment because you have too much now. But when you are going below the lower limit, showing that you don't have cash again, what will you do? You buy your investments. You sell your investment rather to get what? To get cash. To get cash. To get cash. So this Miller-Orr model, it works based on the fact that cash balance reaches the upper limit. The firm invests what? The excess cash in securities. If cash reaches the lower limit, the firm sells securities to raise what? To raise cash. Now, the target level is what? Is the point you have to return your cash to. that is cash returns to target level, the ceiling you set as an organization. So there is a formula to solve questions that involve Miller-Orr. This formula is in your question paper. If you've taken time to study your question paper very well, you know, most times after the exam, we just throw the question paper away. You don't know what is behind it. So you can, if you still have it after this class, just go. Don't be angry with the question paper. Some of you are angry with the question paper. So don't be angry with it. Just pick it and you see these formulas there. Yes. So, but the point is, as you solve, let the formula be part of you. Yes. Let the formula be part of you. I don't used to think of the fact that there is a formula behind the question paper. So I just allow the formula to rest with me. So this is a diagram explaining what I've said, that the model sets higher and lower control limits, that is H and L respectively, and the target cash balance. Yes. So when the cash balance reaches H, that is reaches this point H here, this is the maximum level, that dollars are transferred from cash to what? To marketable securities. And when the cash level reaches the minimum, what happens? You transfer, dollars are transferred from marketable what? Securities to what? To cash. So this is using dollar as a scenario here. So this is the Miller-Orr model. Let's see if we have the formulas. Okay, fine. We have these formulas that, please write this down in your book. The formula, this is given in the examination as I've stated. Write it in your book. Upper limit, for you to get upper limit. For you to get your upper limit, it is your lower limit plus spread. Your lower limit plus spread. Lower limit plus spread. And for you to get your return points, it will be what? Your lower limit plus. Yes, this was the point. Somebody was asking me that last night. All these things, how did they come about it? You know, we are not here to prove these values now. If you go and check that question paper, you see them like that. Yes. Though I've not taken my time to even see the proof. Yes. Maybe when I have time, I will see how I can come up with, see how they come up with all these values. Yes. So now I don't have the time. So the return point is your lower limit plus what? 1/3 multiplied by your spread. Your spread is what? For you to get spread, it is 3 multiplied by what? Into the brackets. We have 2 brackets here now. We have the inner one. The inner one is carrying what? 3/4 multiplied by what? Your transaction cost multiplied by variance of cash flow. You close your bracket. Then divide by this interest rate, divide by the interest rate. You can just bring it under these values here. Then everything in the bracket, everything is raised to the power of what? 1/3. Take notes. Is raised to the power of 1/3. So what it is when you solve, you have to follow the rule of BODMAS. Yes, you treat this issue in this bracket. Now, when you are giving standard deviation in a question, what will you do to get your variance? For example, let's say the question mentions standard deviation. To get your variance, what will you do?
You square the value you get as a standard deviation.
Okay. We square the value we have as our standard deviation to get the variance. Okay. Okay. So the square roots of variance is what?
Standard deviation.
Okay. and the square root of variance is standard deviation. So now, some questions will not give you variance directly. They will not give you variance. They will just give you standard deviation. So the square root of variance is standard deviation, and the square of standard deviation is what? Is variance. So to get your return point is lower limit plus into the bracket 1/3 multiplied by spread. Your spread is what? 3 multiplied by to the bracket 3/4 multiplied by transaction cost multiplied by variance of cash flows divided by interest rate, all to the power of 1/3. Let's see. We have an example to illustrate this. I said note, variance and interest rate should be expressed in daily terms. Yes, this is very important. At this point, some questions will give you some values in year, some values in days. So you must make sure you work based on days or based on year, whichever you want to work with. So you don't put some values in days and put some values in years. You will not get the right answer. So if the question provides you with standard deviation of daily cash flows, you will need to square this number to obtain what? The variance. To obtain the variance. Take note. Let's look at this example. A company has decided it needs a minimum balance of $10,000. Of $10,000. The transaction cost is $5 per transaction. $5 per transaction. $5 per transaction. The standard deviation of cash flows is what? Is $2,000 per day. The interest rate is what? 5.11% per annum. In days, it can be 5.11 divided by what? 365 days. Then you have what? 0.014 per day. Take note, interest rate is always given per annum, even where the question didn't say it. It's always per annum. Or you can now get it in months. When we start solving annual efficiency rates, still on this aspect of working capital, yes, when you do annualization, you see the effect of that. That you can be given something, a figure in months, but they want you to solve in days. So you will see how we treat those issues as the lecture continues. So now the question is, what should be the upper and lower limit and the return point? The formula given in the examination of the Miller-Urr model are, okay, we have the formulas already. We have the formulas already. So to get the upper limit, in this question, do you think you have the lower limit? In this question, do you have the lower limit?
Is it not the minimum balance?
Very good. And the minimum balance is what?
$10,000.
Yes. So it means lower limits. Lower limit is what?
$10,000.
$10,000. Now, for you to get the return point, the formula is what? The return point, the formula is what?
Lower limit plus 1/3 times spread.
The return point. The return point will be equal to what? Your lower limits. Lower limits plus what? Plus
1/3
multiplied by what?
spread.
Multiplied by spread. The question now is, what is our spread? Our spread. This is our spread formula. This is the spread formula. So to get our spread from the question, let me paste this again. 3 is constant, as the formula provides. 3/4 is constant. The question we have to ask ourselves, what is the transaction cost from the question? The transaction cost is what?
$5.
$5. Variance of cash flow is what?
0.014.
The standard deviation of cash flow is
2,000.
$1 per day, isn't it?
Yes.
What will happen?
Square.
In the question, you are giving standard deviation, not variance, right? To get your variance, when you get standard deviation, what will you have? And see,
44.72.
4,000, 2,000, right? 2,000. When you square it, what will you have?
That's 1 million.
44.7.
4 million. 4 million.
4 million.
4 million. When you square it, you have 4 million. That is the English here. You are giving standard deviation, and the formula is what? Variance of cash flow. The formula is variance of cash flow. Your
Sorry,
standard
sir.
deviation to
Why are
get
we
what?
squaring the variance?
In the question, they didn't give you variance. They gave you standard deviation. And we explained before now that where you are not giving variance and you are giving standard deviation, what will you do? You square your standard deviation to get what? Your variance. That is statistics. Hope that is clear.
Yes, thank you.
So, what will be your interest rate? What will be your interest rate?
0.014.
Why are we using 0.014? Why not 5.11%?
Because the data given to us is for per day, not annually. So we
Okay,
have to
fine.
convert the annual rate to daily rates.
Fine. And because if you look at the question, that the transaction cost is $5 per transaction, the standard deviation of cash flow is $2,000 per day. It means you must match the cash flow with the interest in terms of day. If it's you are working based on year, then you match it based on year. But we are working based on days, and that is why we will use the interest per day. The interest per day. And that will be what? That will be 0.014% will be what? You know, some people will just carry that 0.014 and put. But 0.014%, what is the value? Where's your calculator? 0.014
That's
divided
0.0014.
14.
Yes.
So
0.0014.
So where the big drama will come now is how to press my calculator to get my final answer. I recall last diet, we did a lot of drama in pressing calculator. So I hope we'll quickly get it now. So for us to solve, it's one thing to put your variables, it's one thing to know how to get it right. So now, let's solve for the values in brackets. 3/4 multiplied by 5 multiplied by 4 million. What are we going to have?
12 million.
12 million. Check it again.
It's 15 million. No? 15 million.
50 million, sir.
So the spread will be equal to 3 multiplied by, okay, let's copy this. So when you multiply all this, you're going to have 15 million. 15 million. So 15 million divided by 0.0014 will give you what? $15 million divided by 0.014 will give you what? It will give us what? Or the figure is too big.
$107 million, 142,000, 107,
yes,
142,
142,
857,
857,
142.
142 again.
Yes, sir.
Wow. Okay, well, let's see.
Yes, sir.
Ma?
It's in billions.
This that figure. That figure, my
It's-
calculator
the
is
figure
showing
is
me
107.
It's giving me 1.07 142 8571.
but in
Okay.
standard form.
Okay. Yes, in
It's
your
standard- standard
on your calculator, ma. The standard form
Yes,
is
sir.
raised to the power of what, ma?
11.
Very good. So you add 11 zeros to those to the value you have there.
Okay. Use it back 11.
So hope we are getting these figures. Class, I want to get a response.
Yes, sir.
No.
Madam Joy, you are not getting it.
My calculator, I don't understand you.
So you didn't approximate it. At the end, we have a 0.85. Is that correct?
Yeah, I didn't press my own calculator. It's in my bag. I don't want to go and lose my.
Yeah, I'm using the big calculator, so all the figures are there. The 12-digit calculator.
Okay, that is a market woman calculator.
I have the two, both the scientific and that one. When the numbers are too many, I use the big one.
Okay, all right.
So I had 0.85 at the end.
Okay. Okay, it's
They say
fine.
the same thing, 0.86, yes.
Okay. Okay. So, can we get the final results?
Excuse me, sir.
Yes, ma'am.
Sir, I'm still not getting the standard form of the thing. It's in standard form of 11.
Yes, what do
And
you
the
have?
figure,
1.07.
the figure is not up to 11.
No, I
The,
understand.
the okay, the 4-2 you put at the back, I don't know where that my calculator stopped at 7-1, but you added 4-2 to your own figure.
Yes, that is what they gave me, ma. Mr. Friday, from your calculator, what do you have?
That
Or is
figure
it,
he gave you is not correct.
It's 142.
so what is the correct figure?
The figure is
Okay.
107
107 142
107 142
857
857 142.85.
0.86.
Okay. So is this fine now?
That is 143.
Okay, just give me the final answer. Let me know. What will be your final answer?
14248.71.
Okay. 142.48.71. Yes, I need other answers. Spread. $14,248.71. Yes. I need other from your computations. Are you getting other figures aside this? $107,142,857.86 to the power of 1/3 multiplied by 3. You're going to have what?
I got 107, 142.
It's correct, sir. It's correct.
Okay, so 14,248.71 is correct.
Yes, sir. Yes, sir.
All right. So in case you're finding difficult to do to the power of 1/3, 1/3 on a normal day is what? 0. What?
0.33.
Fine. You can just say that value in brackets to the power of 0.33. Then you get your value multiplied by 3. Then you have your spread, the figure for your spread. So now that you have the value of your spread, you can still go back to your solution. To get your return point, it will be what? To get your return point, it will be your lower limit, which is what? Which is $10,000 plus 1/3 multiplied by the spread. The spread is what? 14,248.71. And this will give you the value of return points to be what? The value of return points will be what? The value of return points will be what?
47 million. 47 million.
Okay. 47 million.
497,000. 495,700. Sorry.
495,700.
700.
I need a confirmation to this. 1/3 multiplied by 14,248.71 plus 10,000.
Oh, sorry.
So it's 14749.57.
749.57.
Yes, 14749.57. Yes.
So this should be what the outcome should be. I'm not using these assignments. I gave these assignments. Let me come up with another assignment. So we have 2 assignments as far as this slide is concerned. Assignment 2. Assignment 2, you can write the management of Emmy Limited. The management of Emmy Limited has agreed that its minimum cash balance should be 25,000 naira. It will be 25,000 naira. The anticipated standard deviation of its daily cash flows based on trend is 2,000 naira. 2,000 naira. The estimated transaction costs per purchase. Transaction costs per purchase or sale of short-term investments is 75 naira. And annual market interest rates. On short-term investments is 8%. It's 8%. Required calculates the upper cash limits. Calculate the upper cash limits and the return points. The upper cash limits and the return points using Miller-Orr model. Using Miller-Orr model. So this is a question to further test our understanding of this subject matter. So I implore you to solve and send your solution to the platform, to the group. So this is the number 2 question, and the number 1 question is this one. So
Sorry, please. Answer number 1 question.
yeah, I'll forward the slide to you as soon as we complete the class now. Forward the slide to you.